All right, well, let's get right into it because what the world's sharpest investors are doing right now, well, it seems to make zero sense. On one hand, you hear them warning about a massive AI bubble, that a $5 trillion credit bomb is about to go off. But then, in the very next breath, they're quietly pouring billions into some very specific stocks. So, what's the real story here? What do they see that the rest of us don't? And this slide right here is the perfect example of the paradox. You've got Ray Dalio, the guy who founded the biggest hedge fund on the planet. He goes on record saying AI is a bubble, comparing the hype to the crazy days right before the big market crashes in 1929 and 2000. But then, get this, in the exact same period, his fund massively increases its bet on a key AI hardware company by over 50%. This isn't just sending mixed signals. It's a very deliberate two-sided strategy, and that's exactly what we're going to break down. So, first, let's talk about the scary stuff. To really get why they're buying what they're buying, you have to understand what they're so worried about. And believe me, the warning signs are flashing bright red. Let's just start with a number that should make you sit up and pay attention. $5 trillion. That's the figure that Jamie Dimon, the CEO of JP Morgan, is flagging. He sees this enormous hidden risk building up, not in the stock market, but in a shadowy corner of the financial world called private credit. So what exactly is private credit? Well, think of it as loans made directly from one company to another, completely bypassing the normal stock and bond markets. The big problem? It's totally opaque, and a lot of the usual safety nets for the lenders have just been tossed out the window. According to the IMF, a whopping 40% of the companies taking on this kind of debt don't even make enough money to pay their bills. It's like a huge fault line running just beneath the surface of the entire global economy. And it's not just some hidden debt problem either. Just look at the regular stock market. This chart shows something called the Shiller PE ratio, which is just a fancy way of seeing if stocks are cheap or way too expensive. Historically, the average is around 17. Right now, we're pushing 40. The only other time in the last 155 years that the market was more expensive was at the absolute peak of the dot-com bubble, right before it burst. That is a massive, massive red flag. And if that wasn't enough, there's this debt wall coming right at us. We're talking about trillions of dollars in corporate loans that have to be paid back or refinanced, like right now. All those companies that borrowed money for next to nothing a few years back, well, now they have to get new loans at rates that are double, sometimes even triple what they were paying. That's going to put an absolutely brutal squeeze on their profits. And this is where that famous Warren Buffett quote just hits perfectly. All these pressures, the secret debt, the sky-high valuations, the rising interest rates, that's the tide going out. And we're all about to find out which companies are standing on solid rock and which ones, well, have no clothes on. So how are the pros actually playing this? They're selling. Warren Buffett, for instance, has sold more stocks than he's bought for 13 quarters in a row. He's now sitting on a record-breaking $373 billion in cash. His fund just slashed its Amazon position by 77%. Hedge funds as a group just pulled off the biggest sale of tech stocks since 2020. And Michael Burry, the guy from The Big Short, he's put down $1 billion bet against the AI hype. They're all quietly and methodically getting more defensive. Okay, but here's where it gets really interesting. This is the big twist. At the very same time they're selling off and piling up cash, these exact same people are making some huge, very focused bets. They're not just running for the hills, they're going shopping with a very, very specific list. And this is just wild. You've got three legendary investors with completely different ways of thinking, all landing on the exact same company in the same quarter. Micron technology. You have Dalio, who looks at the big picture of the global economy. You have Tepper, who's a master at finding opportunities in chaos. And then you have Renaissance, which is run by computers and pure math. They all looked at the world and somehow decided that Micron, a company that makes the super-fast memory chips essential for AI, was the place to be. And they all bought in big time. And hey, this isn't some isolated thing. Bill Ackman is pouring billions into Meta, which obviously has huge AI plans. Seth Klarman, who's known for being incredibly cautious, just made Amazon his number 2 holding, a clear bet on its cloud business, AWS, dominating AI. And George Soros? He just dropped nearly $11 billion into healthcare stocks. So you see the pattern, right? They're selling the market, but they are buying very specific companies. So what you start to realize is this isn't random, and it's not a contradiction either. It's a playbook. There is a very clear logic that connects everything they're doing, both the selling and the buying. And understanding that playbook is everything. And that playbook really boils down to three simple rules. First, you bet on the actual infrastructure, not the speculative hype. Second, you follow the giant, unstoppable trends that are going to happen no matter what the economy does. And third, you look for real value in places other people might be ignoring, just to give yourself a cushion. This first rule is perfectly captured by this great analogy from investor Howard Marks. He talks about the old railroad boom. You could have tried to guess which one of the dozens of train companies would win, or you could have just invested in the company that sold steel rails to all of them. The smart money today is betting on the steel rails of AI, the memory chips, the data centers, the power grids. It doesn't matter which AI app wins if you own the stuff they all have to buy to even exist. Now let's talk about rule number 2. Investing in those unstoppable mega trends. Just look at where new money went last quarter. More flowed into healthcare than any other sector. Why? It's a bet on demographics. The world's population is getting older, and older people simply need more medical care. That trend doesn't care about interest rates, it doesn't care about recessions, it's just going to happen. It's a powerful force of nature. And that third rule is beautifully simple. Buy value. Bill Ackman's huge bet on Meta is a perfect case study. He gets to be a part of the whole AI revolution, but he's doing it through a company that's trading at a much more reasonable price than a lot of its high-flying peers. The point is, it's not just about what you buy, it's about how much you pay for it. Getting in at a lower price gives you a buffer, a margin of safety, in case things don't go perfectly. So after looking at all these mixed signals, the selling, the secret buying, what's the big takeaway here? How does any of this apply to how we should be thinking about our own financial lives? Well, I think this is probably the most important lesson of all. None of these legendary investors are claiming they have a crystal ball. They don't know what's going to happen next. They aren't predicting a crash, and they aren't predicting a boom. What they're doing is preparing. They're building a portfolio that's tough enough to survive a storm, but also has the cash ready to pounce on the amazing opportunities that a storm can create. And here's the fundamental reason why being prepared is so much more important than just being aggressive. It all comes down to something called the asymmetric math of loss. It sounds complicated, but it's a really simple idea, and it's probably one of the most powerful concepts in all of finance. Just look at the brutal math on this. If your portfolio goes down by 30%, you don't just need a 30% gain to get back to where you started. Nope. You need a 43% gain. The deeper the hole you fall into, the harder and steeper the climb back out becomes. And that is why protecting your money on the way down is mathematically more important than squeezing out every last drop on the way up. It's why Buffett is happily sitting on $373 billion in cash. So, if we boil this entire strategy down, it really comes to three key ideas. Number 1, bet on the physical picks and shovels that power new technologies instead of trying to guess the winner. Number 2, invest in those long-term powerful megatrends like demographics that aren't tied to the economy. And number 3, and this is the big one, use the calm times, like right now, to prepare. Build up your defenses, have some cash ready so that if a storm does hit, you're the one who gets to buy when everyone else is panicking. And really, that's the question to leave you with. The smartest investors aren't making one single bet on what the future holds. They're building a portfolio that can handle whatever comes their way. So the question we all need to ask ourselves is, have we done the same? Is our portfolio ready for the storm, or is it only built for sunny days?